Okay, so hello, madam. Today we are going to present our poster, which is the basic accounting concept. My name is Elisha Cassandra, and my member will introduce themselves when they present their part. So the first topic that we choose is the accrual concept. So the definition of this accrual concept is that the journal entry used to recognize revenue and expenses that were earned or consumed, which is also related to the cash amount that have not been received or paid out. It is an important part for closing process in order to generate the financial statement. The example of accrual concept is the account payable. So let's say that the company A has salary payable of 40,000. Then how should we treat this based on the accrual concept? So there will be two effect of this account, which one of it uh, will be recorded as salary expenses in the income statement, and then the other one will be treated as the current liability recorded in the company's balance sheet. And this picture attached is how the account payable will be recorded. And then next one is the prepaid expenses. Um, let's say that the company B has a prepaid wages of 100,000. So how should it be treated? It is the opposite of what I have mentioned above. One will be recorded as wages expenses in the income statement, and then also will be recorded in the current assets of the balance sheet company. So next topic is the objectivity concept. Objectivity concept is it is referred as the principle which states that financial statement should be objective in nature. In other words, the financial information should be unbiased and free from any kind of internal and external influence. So the example of this objectivity concept is the role of auditor. The auditor will make sure that the company will follow the objectivity concept. Um, to make it more clear, for example, if company W has asked an auditing company to do an external audit for their financial record, and if the external auditor start to validate the record, he will ask for receipt from customer for validate the account receivable. And then if the company cannot present the proper receipt to the auditor, then the objectivity concept is violated. So as a result, the statement cannot be verified and cannot be used. And then other example is the case study in 2009, which the Satyam Computer Service, an Indian-based company, the company has present a false account in order to make a lot of profit for their company. The chairman of the company has confessed to the crime and is considered one of the biggest accounting scandal in India. Yeah, in India. So if you falsify an accounting statement, such as entering false order or increase account receivable, then it is a breach of objectivity concept. So the fund that you enter in your book has to be objective and verifiable to consider as the objectivity concept. So that is all from my part. Next, I'll pass it to Adam.
All right. Hi, my name is Adam Daniel. So I would like to present the basic econ principle. So the topic that I will explain right now is the consistency concept. All right. For defining the consistency concept, the basic is like anytime a company want to open a company, they will follow like the exact like how we say the way or their style or even a week or pattern of their accounting. So what is consistency concept is all accounting treatments should be followed consistently throughout the current and future periods. So for example, if at the start the company is doing the A ways, so they cannot do the B ways also because they need to keep the consistency in the accounting method. So why it is important for the consistency concept is because it prevents accounting fraud and makes financial statement comparable across time. So it will easy for the accountants to check if there is anything problem between the uh, accounting statement. So the example of the consistency concept is like the straight line method of depreciation and also the LIFO method for valuation of inventory. So next is the materiality concept. All right. How do we define the materiality concept is it is like every material items that is being transacted in the account must be reported in the financial statement. So material items are those whose inclusion or exclusion cause significant difference or change in the decision making for the business data. So, for example, company A, which is very large and generates income of 40 million, company B, which is very small and it generate net income of 90K. So, with the materiality concept, we can see that it emphasizes the difference in size of two companies and variation in the behavior of the financial statement between users. So everything no every transaction that happen in a company must be stated in the financial statement. Uh, so that is what define the maturity concept, and it's important this concept need to be taken because everything can be keep on track. So uh, any like mistakes can be prevent from happening. All right, that's all from me. So I would like to pass to my next group member.
All right, thank you, Adam. Okay, this is my part. First of all, my name is Rusmawati Masalan. Okay, my part is comparability and prudence concept. Okay, the definitions of this comparability is accounting comparability can be defined as the extent to which the information provided into the financial statement in comparable across different firms and the time periods. Okay, the first example that I can find is assume that a company A, the value is inventory using the FIFO. FIFO is finance in and finance out method, and company B use the LIFO method. If everything else is equal, company B's financial statement will mostly like show less income due to the higher cost of goods of yes goods sold. Okay, and company A, on the other hand, would have a lower income but a higher inventory. These two companies' financial statement are not comparable. They use the various accounting method to probably compare this statement. Okay, the second example is currency. Okay, currency. For example, to compare, for example, okay, currency Malaysia and currency of Singapore. To compare them is a big difference. So this comparability can make sure the value currency of Malaysia and Singaporeans value of their currency lah. For example, as we can see in the photo, if you buy a new car, okay, and after 10 years, the value will reduce. Okay, and the next one is a previous concept. Okay, the definition is a critical accounting principle. It's ensure income and asset are not overstated in financial statement. Sorry, ensure that liabilities are not understand and that provisions for income and also losses are met, and also known as a conservatism principle. For example, making provisions of debt doubtful debt in anticipations or actual bad debts, and also never providing discount on creditor, and also making provision for discount on debtor in respect of the discount. And this is the example, as you can see here, the example of the calculating of the prudence concept. And that's all for me. I pass to my other friends. Thank you.
Okay, thank you, Kak Ros. So my name is Muhammad Fahim. So I will be explaining about the money measurement and historical costs. So for money measurement, a business should only record an accounting transaction if it can be expressed in terms of money. The focus of accounting transaction is on quantitative information rather than on qualitative information. Also, a large number of items are never reflected in a company's accounting records, which means that they never appear in its financial statements. So there are two examples, which is employee skill level and employee working condition. So for historical cost, the historical cost of an asset refers to its purchase price or its original monetary value. Based on the historical cost principle, the transaction of a business tend to be recorded at their historical cost. The principle states that a company or business must account for and record all assets at the original cost or purchase price in their balance sheet, and it also applies to liabilities. The example that I have is Julius owns an investment firm that has acquired various properties across Southern America. Assuming that inflation level across the region have doubled over the recent years, the property investment are not worth anything close to what Julius spent on acquisition. The historical cost principle does not account for adjustment due to currency fluctuation. Hence, the financial statement will still be recorded the value of the asset at the cost of the purchase. So that's all from me.